Good morning. The U.S. downgrade in August last year was based on three main factors. The first one was the high level of debt.
Asking you very sorry.
No, the answer. I come to that. The answer is no.
You don't accept it.
I don't accept it.
Okay.
I was about to explain what happened.
What don't you accept of what was set out by John Bellows, the Assistant Secretary for Economic Policy, in his article on the 6th of August 2011? What is it that you don't accept?
Okay.
About the 2 trillion. I'm not asking you about whether it was right to downgrade or not.
Correct.
First of all, I'm just asking you about this $2 trillion alleged error.
Right. The discussion with the Treasury Department in Washington was about which of the scenarios which were published by the Congressional Budget Office, which is a nonpartisan institution, should be underlying the analysis. Originally, the S&P team was of the assumption, or was following the alternative scenario of the CBO, the alternative fiscal scenario, which in terms of expenditure trajectory did foresee a growth in spending in line broadly with nominal GDP. Following discussions with the Treasury, as they are habitual in interactive relationships with the issuer, S&P agreed with the Treasury that the baseline scenario of the CBO would be the appropriate scenario to use. Now, this is an entirely normal process of interaction and discussion about future policy measures taken by a sovereign government. The 2 trillion alleged error, the 2 trillion is the following number. The 2 trillion is the difference in the net debt ratio in 2021, depending on which scenario you use. Under the alternative scenario, which we had initially pursued, the debt ratio in 2021 would have come up at $22 trillion US dollars. I'm using round numbers, 22.1, which is 2 trillion higher than under the baseline scenario, which is 20 trillion. So the baseline scenario is the one that the committee looked at, that was presented to the credit committee after the discussions with the Treasury, and it was on that basis that the decision in August was taken.
I'm just trying to get to the heart of it. He is alleging, and the US government is alleging, that a serious mistake was made, and you're saying they're the people who've made the mistake.
No, there was no mistake made by either side. There are different scenarios. These are measures about the future, which you have to have an analytical debate on what is the likely strategy of fiscal consolidation the government might take. The CBO itself, these are all CBO scenarios that we used. It's not an S&P scenario. The question was merely which of the various CBO scenarios that have been published should be underlying the rating assessment. And we did agree with the Treasury that it should be the baseline scenario, which would lead to 20 billion rather than 22 billion. So there was no mistake on their side, and there was no mistake on our side.
Let's just read that. So he just made a mistake writing an article saying there was a mistake. I mean, what he says, and I'll read you what he says. He says, Standard & Poor's presented a judgment about the credit rating of the US that was based on a $2 trillion mistake. After Treasury pointed out this error, a basic math error of significant consequence, S&P still chose to proceed with their flawed judgment. He thinks you've made a mistake.
Well, I just represented to you
there's no mistake on either side.
Yes.
So you must have made a mistake in thinking you'd made a mistake.
Well, I can only describe to you the turn of events from the time back then, and the turn of events are, as I described, this is a normal discussion that you have with governments when you meet the government officials to discuss what is the likely turn of policy choices that will be taken. Now, clearly, in the future, you can have various scenarios. Happily, there were various scenarios on the table published by the CBO, and it's a natural process to discuss which is the most likely scenario that should be our base case when we assess the credit risk of the United States in this case. And the Treasury and S&P were in agreement that the one that we used is the proper one.
And you didn't change the scenario after you heard about the 2 trillion?
Well, the scenarios there are in the public domain. We knew about the various scenarios before.
You didn't change the base case scenario?
Well, as I said earlier,
about the 2 trillion.
as I said earlier, initially.
Sorry, just clarify. Did you change the base case scenario after you heard about the 2 trillion?
No, we did not hear about the 2 trillion by the Treasury because this was the outflow of the published scenarios by the CBO. What happened in the discussion with the Treasury is that the Treasury did make a credible statement and a credible stance that the base case scenario of the CBO is the proper one to adopt, and we agreed to that. Although originally we were planning to use the alternative scenario. I mean, this is the value added of an interactive relationship, that you hear the view of the government, and we thought they made a credible statement on that.
The US Treasury will be listening to this, and they can submit evidence if they choose to us on that point and to Congress. Was the rating committee reconvened to discuss this 2 trillion issue?
The rating committee discussed the various scenarios. Under both scenarios that we discuss here, the outcome, according to our published criteria,
I'm sorry to keep getting back to the question, but I mean, there's a sequence of events here. When the Treasury, when US Treasury pointed out what they consider to be, and they still seem to consider to be, this $2 trillion mistake, this was still prior to your decision to issue the downgrade, was it not?
The discussion between S&P and the Treasury was prior to the credit committee that decided the downgrade.
That's what I've just asked you. The answer to that's yes. Now, when that discussion took place and you learnt about their view of this $2 trillion mistake, did you reconvene the credit committee?
Again, I refute the name mistake in this context.
I said their view.
Their view, yes, but I just want to make clear that it's not our view. We did convene a committee which discussed the mutually agreed scenario, which is the CBO base case scenario leading to a $20.1 trillion net debt in 2021. So the answer is yes.
Okay. Since the downgrade, the yield on US government bonds has fallen by more than a fifth. How does that square with your judgment?
It does square with the judgment. What we have to understand is that the yields and the capital market developments depend on many, many factors. One of them being an opinion issued by a rating agency. My interpretation of market developments is the following, that there has been, not only in the US, but more generally globally, investors' flight to quality and safe papers. And there are a number of those available, one of them being the US Treasury bond.
Yes, so they've all moved broadly together, I expect, haven't they? Germany being another example of a beneficiary of the flight to quality, along with the US.
Correct.
Right. And so you've got and the UK. So you've got a number of countries that you've not downgraded, sitting there that have benefited from this flight to quality, but one you have downgraded is also benefiting. Why do you think that might be?
Well, that might be, first of all, we need to keep things in perspective. The sovereign credit rating of the United States is AA+, which is signaling our belief that there is an extremely small probability of default.
But a higher probability than there was before?
A marginally higher probability as before, correct.
Okay.
So I think the flight to quality phenomenon that we're observing is something that you need to look at the various alternative assets that are at the disposal of the investors, and the investors take the view that this is a safe place to put the money. Now you need to remember that ratings and market yields do correlate over a very long term and over the whole spectrum of the ratings, but it's not the case, although it's sometimes perceived as such, that if a rating agency lowers or raises the rating, that automatically the refinancing cost of that particular issuer would change.
Do you really believe that the US capacity and willingness to repay is lower than that of, say, Finland?
I do.
And you take into account there that Finland has huge exposure as a small country, not least to Russia, but to very powerful regional factors, and that the country is heavily exposed to one industry, unlike the huge diversification of the United States. And still you come to that view.
We rate sovereigns, and we rate all 127 sovereigns that we rate according to a published and transparent methodology. One of the key elements in the methodology is the political environment, and it also has to do with public finances. On both accounts, if you want to compare the US with Finland, you will notice two things. First of all, that the debt ratio in the US is much higher. You will find that the debt trajectory is more adverse, but most importantly, you will find that has been our finding at least, and people may come to different conclusions on that, but we felt that the governance challenges that the US political system is facing in generating a coherent strategy of getting the public finance challenge under control are more pronounced than they are in Finland. And specifically last summer, the US government got extremely close to a real liquidity crisis. Because the Washington establishment could not agree on the way forward that would have been required to raise the debt ceiling.
Would you think that there is any truth at all in a point put to us by a sovereign risk expert, many years experience in the field at a high level, who has given us advice, and I quote, "Like journalists looking for a splash, each agency will wish to be the first to move and hit the headlines with new developments suggesting a rating should be reviewed or changed, rather than be seen to follow competitors. Sovereign ratings generate a lot of publicity for the agencies. In other words, this is partly a marketing operation." Do you think there's any truth at all in that?
No, I think there's no truth at all. We do apply criteria to all the sovereigns, and we do assess all the sovereigns according to this criteria, which, by the way, has generated very satisfactory results in terms of the probabilities of default and the ranking of creditworthiness of sovereigns. It is our view that our duty to the marketplace consists of assessing in a timely way the credit characteristics of various sovereigns, and if we believe that they have changed, we consider it as our duty to inform the general public of this changed opinion as soon as possible, and that's exactly what happened in this case, and that happens in all other cases.
Thank you. Andrew Nelson.
Thank you. Mr. Wilson, does Moody's think that Standard & Poor's was right to downgrade the American credit rating?
Really, our rating differs from Standard & Poor's, so our judgment is marginally different from theirs.
So, do you share their concern that the United States might in fact be marginally less creditworthy than or able and willing to pay its debts than either the UK or Finland? And you have the US on negative watch, don't you, at present?
We do, yes. The US and the UK ratings are the same, implying the same broad view of the probability of default and the loss in the event of a default. Finland's AAA rating remains stable for now.
So with your negative watch on the US, you consider that the US could become more likely to default than Finland. Is that the implication of that?
The implication of a negative watch is that the downside risks to a particular rating level have become marginally higher.
And so do you think it is plausible and credible that the US might have the desire not to repay its debts or the inability to repay its debts? Is that really what your thinking is in Moody's?
I think it's important always to bear in mind that these very high rating levels, particularly at AAA, whatever the outlook, that represents a view that there is a very strong willingness and ability to repay debts. So the negative outlook on the AAA does not reflect a view that there is a significant risk of a lack of willingness or capacity.
Right. And Mr. Riley, do you think that it's reasonable for a ratings agency to effectively hold a government to ransom, saying unless they do something about their debt ceiling, then they will lose their AAA status? Is that a reasonable way for a credit rating agency to behave?
I don't think it's reasonable for a credit rating agency to, as you suggest, hold a government to ransom. I think it is reasonable for a credit rating agency to express an opinion as to what might influence the credit rating, and if that is a failure to reach agreement on raising the debt ceiling, which could result potentially in a missed payment on a debt security, it would be remiss, frankly, of a rating agency not to express an opinion as to the likelihood of such an event and what that might imply.
But to what extent should ratings agencies take into account the public nature of sovereign debt ratings at such a very sensitive time in the immediate aftermath of a global financial crisis? What kind of public duty do they have to try and preserve credibility in sovereigns?
Well, I think it's incumbent upon all of us, including the rating agencies, to do the role that we play in terms of each of the participants within the market. In the case of the rating agencies, our role is to provide a third-party independent assessment of relative creditworthiness, including of national governments. That's what we say we do. That's what we seek to do according to our published criteria. And I think in terms of helping to issues about sort of post-crisis or during the global financial crisis or the current crisis within the Eurozone and financial market volatility, then I think where we can help address that is not by pretending those issues aren't there, but to try to address them in terms of our ratings in a very timely but also in a very transparent manner. I think that's a reasonable thing for us to do.
And do you worry that ratings agencies all move in the same direction at the same time? I mean, do you have any completely... can you give us any examples of where you all completely disagree and have rated an entity completely differently? Because we've heard from previous witnesses that the idea of several different credit ratings agencies is that you're all completely independent and would come to separate conclusions. And yet in the case of the US market, we've clearly seen that the entire market disagrees with S&P's downgrade. So that does suggest that either S&P, Fitch and Moody's are all wrong to be so negative about the US ability and willingness to repay, or that you're all guilty of groupthink and the market is actually working in the opposite direction. So can you give us an example of where you all completely disagree and have rated something completely differently?
In the sovereign space?
Doesn't matter, in any space. Can you think of anything where you've all completely disagreed?
Well, it depends on the definition of completely disagree. We have different ratings. I would actually say we do have a different rating.
All right, well, let me be specific. Do you have an entity that you are on Credit Watch to upgrade, where another agency has it on Credit Watch to downgrade, for example, where you're setting the direction in completely opposite ways?
I'd have to check, but if my memory is correct, I think we'd moved, for example, to a negative outlook on South Africa, and I think during that time, I think Moody's may have taken a positive rating action. There certainly have been instances where each of the rating agencies have certainly maintained different ratings during the course of time. And have taken different rating actions. I think it is relatively rare for each of the three major rating agencies represented here to be moving in opposite directions, and I think that's because the fundamentals of our credit analysis, there's sufficient overlap, though they do differ, but there's sufficient overlap such that our rating opinions are likely to be influenced by some common factors. I don't think that implies groupthink, and I don't think that implies that each is following the other. It's that there are some common factors which influence the creditworthiness of sovereign governments.
So that might then question what the point is of having so many credit ratings agencies, all commercial companies, all charging significant sums of money and all drawing the same conclusions, because what you're saying is that the results are obvious, so there's no need to draw different conclusions.
I don't think you can infer that from the response that I've given.
So what's the value of having the three of you there if you all agree, bar at the margins, very occasionally? I mean, neither you nor Mr. Wilson are making an impassioned defence of the US economy and the fact that S&P were mad to downgrade them. Why aren't you making that impassioned defence?
Well, you've not asked us to make a defence of our particular rating, so it's not really for me to speak to
I've asked Mr.
the rating of another agency.
I've asked Mr. Wilson if he thinks S&P were right to downgrade. He says that they just don't agree. What's your view? Was S&P right to downgrade the US?
We don't share S&P's judgment, both in terms of the size, the commitment under the Budget Control Act in terms of deficit reduction, or in terms of the ability of the US to sustain a higher level of debt than a number of other sort of peer sovereigns because of the role of the dollar and the size and diversity of the US economy. We do have a negative outlook, however, on the US because in the absence of agreement on a credible deficit reduction plan, at some point in the future, even the US will have a debt burden that is no longer consistent with it being AAA.
Okay, thank you.
Pat McFadden.
To ask you about the UK. If I could begin with you, Mr. Wilson. The UK enjoys a AAA rating at the moment. Moody's have said that AAA rating is accompanied with a negative outlook. Can you explain the reasoning for that?
Yes, the negative outlook reflects the challenges that we believe the government will face in achieving its debt consolidation objectives as a consequence of the macroeconomic environment, both in the UK and elsewhere, in which it is operating, in which the UK's economy is sitting, and as a consequence of the potential for further shocks to emanate from the euro area as a consequence of the debt crisis.
If I pressed you and asked you about the key risks to the UK's AAA rated status, would you say they were more the external ones of exposure to the problems in the Eurozone or the trajectory of fiscal policy?
The risks, I think there's a first step and a second step. The risk, our view is that in the absence of further macroeconomic shocks, the debt trajectory will be restored and the debt burden will become sustainable as a consequence of consolidation plans. The threats to the plans are in the macroeconomic arena, and those threats are both within, as a consequence of the UK's domestic macro environment and as a consequence of the situation in the euro area. We haven't sought to try to weight those two broad underlying threats to the debt consolidation trajectory.
Mr. Kraemer, do you, just going back to what the chairman asked you about the US experience, do you accept that you and the markets reached very different verdicts about the US, given that after your downgrading, bond yields fell by a fifth?
No, I think the markets and the credit rating agencies, almost by definition, look at different things. We look at the long-term fundamental strengths and weaknesses of an issuer, whereas market participants will look at sort of the profitability of being in certain instruments at a shorter period of time. I would think that there are many examples of that where sort of rating action is not being followed immediately by similar yield changes. And we don't have to go as far as the United States. You can see many of that happening in Europe, for example, where at Standard & Poor's we lowered the ratings of Greece, for example, as early as 2004, and still the market sort of bonanza went on for another 3 years before sort of the markets took a more negative view as well. So I think this is quite unsurprising, and I don't think it is a judgment on whether the fundamental analysis of a rating agency is right or wrong. Overlaying this is, and I would want to express some surprise that there is the perception that the rating agency is always singing from the same hymn sheet, because we've been discussing two credits right now, which is the US and the UK, where the three rating agencies you did invite today have come to different conclusions. So I think the rating is certainly a point of observation that market participants take into account. But first of all, the ratings do not always agree, and secondly, there are many other factors that investors take into account. I would not agree that we should, as a rating agency, try to replicate what the market is doing and trying to have a sort of a rank ordering of ratings according to yields, not least because this would undermine the stability of ratings, because if you analyze the yield developments, you will see that they're much more volatile and almost stochastic at times compared to ratings which are much more stable over time, and therefore give a more longer-term benchmark of credit risk than what markets are doing.
Mr. Riley, Mr. Kraemer's just told us that ratings are one thing and market verdicts are another. Which is the more important?
I think the more important is the judgment that's made by the market in terms of, after all, it's the investors or potential investors who are choosing to lend to an entity or to a national government, or choosing not to extend borrowing, and the terms in which that borrowing is extended. So in many respects I do think that the role of the rating agencies, to be frank, is overstated, partly because one of the strengths, also one could argue one of the weaknesses, but one of the strengths of the rating system is its simplicity. You have a simple grading scale, which obviously you're aware of. And so if there's a positive or negative rating action, it's something which the media can report on very easily. But if a particular investor is taking a position in credit default swap markets or selling UK gilts to buy German bunds, or vice versa, that's something which is quite hard to communicate and is not actually as transparent as the judgments being made by the rating agencies. So first and foremost, it's investors in the market that are deciding, not the rating agencies.
Well, I mean, this is interesting. There's a huge political sensitivity around these ratings, the UK, the US, other countries. And you're from the rating agencies, and you're basically telling us it's not that important, it's what the markets say that matters. In which case, why do people pay so much attention to your verdicts?
Because while I think you asked me the question, who is the most important, and I gave you the response to that. Do the rating agencies have an influence and a role? Then I think they do, in terms of providing information to investors and input into their investment decisions. When investors are looking at a range of investment opportunities, particularly international investors, they're looking at the UK, they might be looking at Canada, they might be looking at Sweden, they might be looking at Germany or the US. And the ratings, which are providing a relative guide to credit quality, along with the supporting research, are one input into their investment decision.
Would you agree with this verdict from Sir Mervyn King? He's referring to the sort of negative outlook action taken by a couple of the ratings agencies, and he said, now what we have seen is that the action the rating agencies took recently actually had no impact on the yield people in the market were willing to lend to the UK government at. What matters are the views of people in the market, not the view of the ratings agencies.
Well, as I say, I think we're broadly perhaps in agreement. I'm speaking for myself on behalf of Fitch, is that the ratings are an input into the investment decisions. We are not making recommendations in terms of buying or selling, nor are we obviously conducting such operations. Does that mean that the ratings are irrelevant, if that's the question really which you're asking? Then I think there is a lot of academic research and research conducted, for example, by the International Monetary Fund that demonstrate that over the longer term, sovereign ratings in particular have provided a good relative indicator, and that actually there is information content in rating actions taken by the rating agencies, and the market over the longer term does, correcting for these other factors which influence their decision, take into account what the rating agencies are saying.
Thank you.
Michael Fallon.
Mr. Riley, you've looked hard at the UK public finances. What kind of credit rating would an independent Scotland attract?
If I may, I mean, given the controversy around our ratings of sovereigns that do currently exist, I'm very reluctant to speculate on sovereign nations which currently don't exist. We don't know the arrangements under which a potentially independent Scotland would come into existence, and so I really don't think I can provide any real value in speculating as to what the rating may or may not be at that future point in time.
But if we assume, say, a pro rata 9 to 10% share of GDP and the bank debt and so on, what would the rating be? If it was an absolutely straightforward mathematical division.
Well, as you're aware, there is a lot of other issues associated with the governance of a potentially newly independent Scotland. So it wouldn't just be the division of the liabilities and assets of the United Kingdom. Obviously, the treatment of the oil receipts, what would be the monetary arrangements of an independent Scotland, what would be the financial sector and banking supervisory arrangements. So there's a huge number of factors that would actually influence what would be what would actually be the rating. So I genuinely don't think it's appropriate or really providing any value to speculate as to what that rating would be.
Is it possible for a country that doesn't have any history in the public finance markets to have a top AAA rating? A sovereign without any history?
Well, history and track record can be important in terms of building credibility, and in fact in our methodology and in our rating model, for example, we have an explicit variable for payment record. You get the benefit for having a clean payment record, and your rating is affected if you have a history of adverse payments.
So can we deduce from that it would be pretty hard for Scotland on day one to get anything near a AAA rating?
I think with all due respect, I think you're trying to get me to make a pronouncement about.
I'm just asking how this works.
A sovereign which currently doesn't exist and which I don't have the information to make the judgment.
You must have done this for other new sovereigns that emerged from Eastern Europe.
Yeah.
This must have happened before. You must have done it for Montenegro and Croatia and so on. So how would it work with Scotland?
Well, we would go through the same process of analysing the information and data that was available. I mean, Scotland doesn't even have a true set of national accounts at this point in time, and obviously talk to the policy authorities and then assign a rating. If your question is, I mean, I'm not aware, at least in terms of Fitch, and obviously others can comment if they're aware of a different circumstance, whereby a newly independent sovereign, whether it be from emerging Central and Eastern Europe, emerging from the end of the Cold War, has been assigned a AAA rating. But I think Scotland, the transition of Scotland from the United Kingdom, I would suggest, would be fairly fundamentally different from the transition of some Eastern European countries from essentially the former Soviet Empire.
Yeah, but I just want to know how likely it is that Scotland would attract a AAA rating on day one.
And I think I've answered the question.
Can Mr. Kraemer help on that?
I have nothing to say to that, and we have not said anything about this. I would take a similar line as Mr. Riley. There is basically no basis of information on which to... I mean, if you look at our methodology, you will see what are the factors that we analyze when concluding at a sovereign rating. None of these factors are known, so I think it would be irresponsible for me to speculate here or in any other forum on what independent Scotland's rating might look like.
Right, Mr. Wilson, I mean, can you be sure that Scotland would have a AAA rating on day one?
Again, it's a highly hypothetical situation, and any answer I gave would be highly speculative and misleading.
Mm-hmm. Have you given AAA ratings to any other newly emerged nation?
I don't know the answer to that, I'm afraid.
Not that, as I suggested, not that I'm aware of. I'm fairly certain that hasn't been the case with respect to Fitch.
It hasn't been the case?
It has not been the case with respect to Fitch.
That some newly launched sovereign nation gets a AAA on day one?
That's correct. I'm not aware of any situation where we have assigned a AAA rating to a newly independent sovereign nation.
Right. Thank you very much.
Jesse Norton.
Thank you, Mr. Chairman. Mr. Wilson, I see that you support, broadly speaking, some of the view that's been taken. In fact, all three, in a way, support the view that's been taken about the US. None of you is prepared to take a view on Scotland. Why aren't you competing with each other?
Why are we competing with one
Why
another?
aren't you competing
Why aren't
with each
we
other?
competing?
Yeah.
Our role is to offer opinions on credit standing. The way we're structured is to, well, certainly the way Moody's is structured, is to draw a very clear divide between commercial parts of the organisation and the rating parts of the organisation. My role is within the credit policy area of the rating part of the organisation, and we focus on ratings. We focus on expressing opinions on credit standing, and that's so.
Has the euro crisis prompted you to review the relative importance of the factors in your ratings when you rate sovereigns?
The euro crisis has
it caused you to rethink the process of how you rate sovereigns?
No, it hasn't. We apply the same methodology now as we've applied for the last 3.5 years, which takes into account economic factors, institutional factors, government financial factors, and the potential for event risk to emerge. And it's those 4 factors that we've applied consistently in determining ratings throughout the crisis.
So can you let's run through the 4 factors again. The potential for event risk.
Yes.
And the other 3?
The first 2 are the economic environment, macroeconomic strength. The second is institutional strength.
Yep.
The third is the government's financial strength, its balance sheet, and the fourth is event risk.
So why didn't you predict, for example, the situation in Iceland? You know, Iceland had a notoriously rickety banking system. You downgraded it 3 times within a year.
The financial crisis has brought many lessons for a host of commentators, including rating agencies, as has the sovereign crisis. I think the 2 together, one of the lessons that we've seen, one of the things that we've observed that we hadn't observed before, was the propensity for markets to act very, very quickly, for market consensus, confidence to change very, very quickly. And that was certainly a factor in the loss of credit worthiness of
An unanticipated factor. You didn't see that factor when you made the assessment.
certainly we didn't anticipate the speed with which the markets could lose confidence in Iceland's banking system, yes.
Do you think that, let me give you a factor you might want to consider in your sovereign ratings for the euro crisis, which is the risk that the stronger countries are going to be used to bail out the weaker ones. Do you consider that?
Yes, we do.
In the political category that you've got?
No, it would be, it's something which we would factor into our assessment of government's financial strength, the potential for contingent liabilities to emerge.
So do you think the situation in France then is now looking weaker as a result? I mean, you now have a government that's potentially prepared to turn its back on austerity, that is going to be tied to assisting countries that are still very, very weak in a flagging monetary context.
What we've said about France is that clearly we will need to stand back and understand the objectives of any incoming government once it's in place. But on the basis of what we've seen so far, the broad objectives of the main political parties seem consistent with the debt consolidation plans which are already in place.
Okay, so other things being equal, do you think countries which have their own currency should have higher sovereign ratings than countries that don't?
The ability to have independent domestic institutions is certainly a strength. It's a strength that we recognise in the UK's rating.
And the case and the ability to devalue, the ability to create a competitive devaluation is a strength. We're seeing this in the UK at the moment.
It's certainly a factor which can boost economic growth, which is supportive.
So other things being equal, a national currency should promote a higher sovereign rating. You've said
methodologies
everything else is equal, so it's got to be. That's
the methodologies we apply take in a very wide host of a range of factors.
Yeah, but other things being equal, from what you've said, domestic institutions and the ability to deflate your currency, that is a value. That is a value. You are saying that's a consequence of your view for sovereign rating.
The ability, the existence of strong institutions which are able to support government policy is certainly a positive factor.
Okay, I can't get you to say it, but it is a consequence of the words you've used. Do you think that why is it, do you think, given some of the warm words that we've had recently from the IMF, that people feel so differently about the value of sovereign ratings? And what's the explanation for that?
Not sure I understand the question.
So we've had some IMF testimony suggesting that there has been ratings have performed reasonably well during the crisis. Okay, European Commission has been very critical of ratings during the crisis. There's a very wide range of views. Why do these august institutions, you guys have difficulty disagreeing with each other? Why don't they have difficulty disagreeing with each other? Why is there such a difference of view about sovereign ratings?
That's really a very difficult question for me as a rating agency representative to answer. I think it's a question that needs to be put to those who hold those views.
Thank you, Jim.
Very roughly.
Can I just turn to Standard & Poor and your banking industry country risk assessment, the BICRA methodology? Could you just take us through the basis on which you give the United Kingdom a 3, which puts us in the same category as Canada, Germany, Japan and the US?
Well, I can give it a stab. I try to be constructive and helpful to the committee. Probably the person would have better placed to answer this would have been my colleague Dominic Crawley, who was in front of you last month. The BICRA methodology is an assessment designed to evaluate and compare on a global basis banking systems, so not individual banks within a jurisdiction, but the banking system overall. When we assess, and that's also true for the UK as for all the other 84 or 85 systems that we analyze in this way, the two main areas, which is the economic risk and the industry risk. The 3 score, which is the BICRA score, which is not a rating, it is a score of relative strength, is held back largely by the economic risks, which have to do with the imbalances in the UK economy, which you could measure, for example, in the leverage of private households in particular, and therefore with the credit risk in the books of the banks. So this, for example, is a theme that you see in other sovereigns as well. If we look at the root causes for the current financial crisis, it's our view that a lot of it is found, it's not a fiscal crisis per se, but it's been sort of a crisis of credit growth, or too fast credit growth and credit risk in the economy. And the UK is certainly one of those cases. It's our view that the UK is currently in what we would call a correction phase. Basically what you have now is sort of banks becoming much more cautious and reluctant to extend new credit, which of course comes with new credit risk exposure.
Could I just stop you there? Because
yes.
you break down your assessment of banking risk to credit risk, and you've observed in your in some of the evidence that there is a downside risk on commercial real estate in the United Kingdom. Would you like to amplify on that?
I would probably think this would have been better covered on the March 7 session, because there you had the man in charge of this particular process in front of you. I can talk in general terms about the main pillars of the BICRA, which I try to do.
Okay, could I just switch to Mr. Wilson on the banking methodology? That's the methodology that Mr. Kraemer's talked about. That's something you subscribe to as well, is it not?
I'm sorry, what is something that I subscribe to?
BICRA.
We have a separate banking methodology, so I'm not sure.
What's it called?
It's called the Bank Financial Strength Rating Methodology.
Fine, okay. Now, have you any view on, let me track back a bit. What were your banking ratings in 2007 before the crash? How were you rating the UK economy? How good was your outfit? What was it assessing as the systemic risk in the UK banking system?
The UK's rating was AAA in 2007.
Not very good, as it turned out, your rating, was it?
I'm sorry, I don't understand the question.
What do you think? Are you aware there's been a financial crash in the United Kingdom? What I said to you was, what was your rating prior to that crash of the UK banking system?
We don't have a single rating for the UK's banking system.
You don't?
Our methodology does not take a system and give it a rating. We only apply ratings to individual institutions, which is why I found it difficult to answer the question about the rating for the system as a whole.
Right, so you don't subscribe to the system, for instance, that Fitch have for a country's. Mr. Riley, you have a system, do you not, which rates the banking strength of a country?
We do. There's two aspects of our system rating. One is actually just simply taking the rating of the standalone rating.
Let's just talk about the country, because there is a submission here that you've actually said that the UK budget is neutral for AAA, and under your system you have intermediate risk assessment for the UK economy, and you have an intermediate risk for the institutional framework, and an intermediate risk for competitive dynamics, which is competition in the banking system, and a low risk assessment of systemic-wide funding. Now, on the assessment that you make for the UK banking, what is that now?
Well, our assessment on the UK banking...
UK banking system. You've scored it, haven't you?
Well, Our banking team have made the scoring on the UK banking system. That's their primary analytical responsibility and lead. We draw on some of that information as part of our
just so we're talking about the same thing, and you break it down to institutional framework, intermediate risk assessment of competitive dynamics, and system-wide funding. That's right, isn't it?
I understand that to be correct.
I'm reading from Fitch Ratings, 21st of March 2012. Where it says UK budget is neutral for AAA status.
Sorry, but you're switching between a comment about the UK budget and
no, listen, can you stop talking? I ask the questions, you answer the questions. Is it the case that you put out something called UK budget is neutral for its AAA status, Fitch Ratings Limited, 21 March? You are or are you not Fitch Ratings?
That is correct.
Thank you. Do you know what I'm talking about?
I don't have a copy of the document that you're referring to in front of me.
Right, and it actually, at length, breaks down the fact that you give a score for the United Kingdom. And you break it down for an intermediate risk on institutional framework, intermediate risk for competitive dynamics, which is the competition in the UK banking system, and low risk assessment for systemic-wide bank funding. Now, have you the faintest idea what I'm talking about? Because this is your own document. Do you think it's sensible coming to this committee underbriefed and not knowing your own business's releases?
I think that's an unfair comment.
Do you know what I'm talking about? You just said you didn't know what this document was about. How is this committee able to ask questions when you come along, complacent, sometimes smirking? I want to know what your assessment is and why of the UK banking system at the moment. Now answer the question.
I think it would be helpful if you give a short reply, and then I think I'll be bringing in somebody else.
No, I want to ask a question after that, a quick one.
Well, I'll ask the supplementary now, David.
I want to know what your rating is for the UK banking system, Fitch.
I'm not familiar with the document that you're referring to, so I cannot answer that question. My apologies.
What is it?
For being insufficiently briefed.
By being incompetent.
On the banking, on the UK banking sector. I'm responsible for sovereign ratings at Fitch, not for all of our banking.
Can I ask one final question? This will be my last question.
Very brief, yeah.
Fitch, as an organisation, what did it rate the UK banking system in 2007?
I'm not in a position to respond
useless.
To tell you that.
Absolutely useless.
But these are issues for which you're not directly responsible, as I understand it.
That is correct.
Yeah. No.
Hopeless.
George Moody.
I'm the good cop. Right. You've got a fairly dismal report from ESMA in view of their last inspection. Inadequate transparency of methodology, problems with disclosure and presentation of ratings, inadequate governance arrangements, inadequate resources supporting ratings, and the use of new and inexperienced staff on too many occasions. Now, apart from that, was everything else all right? Now, were these criticisms justified?
I can speak to the on-site inspection that was conducted at Fitch with respect to our sovereign ratings. We had detailed discussions and they reviewed our files while on site. My understanding at the time of that inspection was that, broadly speaking, the Fitch sovereign team was adhering to the practice, procedures and regulations that ESMA were reviewing. My understanding is that we are still awaiting, as a rating agency, the detailed feedback from ESMA, and if there's things that we need to address in the way that you've highlighted, we will address them.
Are you not aware then of these findings? Is that what you're saying? Or you know of them, but you're waiting for a detailed official formal letter?
I think I'm certainly aware and have read the report that I believe you're referring to, which provides a kind of generic overview of the three agencies that were reviewed.
Well, they refer to one or more of the three agencies they'd inspected, and you're all at the table, so it's either one or two of you fit into this. But do you think they are justified?
I think they've highlighted a number of potential risks relating to things like resources, as you've highlighted, which we recognise as potential risks, and if it's identified that there's a shortcoming on the side of Fitch, whether it be on sovereigns or in other analytical groups, we will address those. I think they're highlighting potential shortcomings and risks, was my understanding, rather than saying that there's systemic shortcomings in the conduct of the rating agencies with respect to the regulations that ESMA is governing the rating agencies.
I'm not sure, I'd just like to take you up on that. I'm not sure they're potential, they're what they found. There's nothing potential about it. Systemic is another question, but they raised important points after the inspections and indicated that one or more of the three of you were found wanting in these areas. There's nothing potential about it.
Well, I can only speak to Fitch, and it's my understanding at this point. Yeah. It's my understanding that there weren't serious shortcomings in the review that ESMA has undertaken, but I also understand that ESMA has yet to revert to us with a detailed report of their review.
Okay. Mr. Kraemer, you have anything to add?
It's my understanding that I can talk about the part of the process I was involved in, which is the on-site process for the sovereign ratings team, and I can confirm that ESMA did a pretty robust and thorough investigation looking into our files. It is my understanding that the final conclusions are still to come. There was an initial draft. That's sort of my state of information. I believe, and we take that very seriously, from what I took away, is that ESMA did comment on certain sort of areas of improvement which have to do with record keeping, which have to do with areas of sort of recording committee conclusions, which are measures, which are remarks we take very seriously, and we have been working on those areas to make sure that that this.
Well, the four areas I've mentioned, are you looking at these four areas as a result of your interim knowledge of their findings?
Well, I'm not sure I recall them all that you mentioned. I don't think they would be applicable when we talk, for example, about inexperienced analysts, which I think is the gravest of all sort of concerns here. For me, as an analytical manager, is something I would feel very worried about. Sorry?
It must have been one of the other two that had
well, as I said, I think the final agency by agency conclusions are still outstanding. So I would, from my perspective, I would actually not subscribe to that view for Standard & Poor's.
Mr. Wilson, do you want to add anything?
I mean, my personal responsibilities are for racing policy, not for the communication with regulators, so it's rather off my patch. As my colleagues have said, I think the challenge we face is that these are generic findings. It's difficult to know precisely what ESMA think in relation to each racing agency until we see the specific findings.
Yeah, I have two questions. One, well, on the important point of methodology and transparency of it, they found credit rating decisions from other products continue to be found in methodologies underlying credit rating decisions for some products continued to be found in multiple documents published in different periods, not easily identified on the CRA's web pages. They went on to say the methodologies published by one or more of you on the rating categories in the selected sample not always provide a clear and exhaustive overview of the criteria and models used and how these criteria contribute to the eventual rating decision. That's fairly important, I would have said.
I think it's an important comment. I would say to this
and not guilty.
I would, well, for the sovereign sphere, we're talking about sovereign ratings here. We have one piece of methodology, which is 2 clicks away from our standardandpoors.com website. We think it is something that we put out in June 2011, superseding our previous criteria,
so
adding lots of layers of transparency.
Your methodology, I would find it all in one place, not as they're suggesting,
You would.
broken up.
You would.
And you're nodding?
Well, I'm nodding because in the case of our sovereign rating methodology, that is the case. The ESMA review obviously was across all of the assets and asset classes that are rated by each of the agencies, and I know they looked at, in particular, in addition to sovereigns, covered bonds and that of banks. And in as much as there's shortfalls in the transparency of the research, its accessibility, etc., then we would certainly make changes to make it more accessible and more transparent. But with respect to sovereign ratings, we have a single document which sets out our methodology, which is freely accessible.
Yeah. Mr. Wilson, does know your area?
Not really my area.
Okay. Right. That's important because in all the written evidence, you each get very upset about the Commission's, three of the Commission's further proposals for further action. And one of them is rating agencies will have to seek and receive approval from ESMA before making changes to analytical methodologies and criteria, and also be required to develop a harmonised rating scale in parallel with their existing rating scale, so you could be compared. Now, that's one you are getting a hot under the collar about. Could you just take the opportunity to explain why you are so excited about that? They're simply saying that you should not make any changes without clearing it with the regulator, and secondly, you should run parallel a methodology transparent model that is similar to each. Mm-hmm. So you can be a customer can look at you and see how you are doing.
Yeah, well, I think what you're referring to is in the CRA3 legislative proposal, the ESMA's powers to approve or disapprove of rating methodology changes. We do indeed believe that this would be a negative development. It would, first of all, it would lead to what we consider undue regulatory influence into the substance of the rating, into the true analytics, rather than the processes surrounding the ratings, which is actually something that the current regulation of rating agency precludes. There was a clear division of labor between regulation and analytical work. I think this clear demarcation would fall by the wayside. It would also lead to unintended consequences, potentially, that what you seem to be worried about, that the rating agencies speak sort of with one voice, and why is there 3 of you or 7 or however many, if ESMA were to be in a situation to sort of approve certain methodologies, the chances are that the methodologies will be pretty similar and therefore lead to a less of diversity of opinions and more aligned ratings across the competition. Which I think would be negative for investors because it would reduce the information available to them. It could also potentially slow down the methodological adjustments to new realities. The methodology is not something that's cast in stone. That is under sort of annual revision, at least, sometimes, as the case may be, at short notice, if the situation changes. If you have sort of an approval process you have to go through, these changes, which may be warranted from the analytical point of view, may take longer to take, and therefore reduce the quality of the ratings. It may furthermore, lastly, and I stop after this, it may increase another risk that some politicians are worried about the over-reliance on ratings. If you are an investor and you have sort of ESMA-approved methodology, you might actually think, well, that should be all right then, and actually reduce the own analytical effort rather than increases, which I understand is the intention of the European policy maker.
Well, just briefly, because I think the arguments have been well set out by Mr. Kraemer, there is a fundamental principle that is actually recognised in the European existing European regulatory framework, and that is actually maintaining the independence of the rating opinions. And those rating opinions are based on our criteria and methodologies that are developed by each of the rating agencies. So it is a fundamental principle to ensure, that we think is important to respect and maintain the independence of the rating opinions and not undermine that inadvertently or otherwise as a result of approval process with respect to the analytical aspects of what we do.
If they went ahead with this, what would you do?
That's a question I generally could not answer. I'm afraid that's a question sort of above my pay grade.
We would work according to the European regulation.
Very good. Andrew Lesson had a question she wanted to make.
Yeah, I just really want to, as a final question, ask all of you, do you understand why politicians and indeed regulators are so concerned about the credit rating agencies' impact on government policy? And specifically, Nicolas Sarkozy, quoted in the Financial Times as the only thing he had to worry about was preserving the AAA. And we've seen a lot of that also in the UK, where there's been a lot of talk about the austerity packages needed to preserve the AAA. So can you understand why sovereign ratings in particular are treading into very dangerous territory vis-à-vis politics? And can you tell me, each of you, are you discussing this at the highest levels in your ratings agency, and are you taking into account at all going forward, or did you previously take into account at all the political impact of the timing and the consequences of your ratings? Mr. Kraemer first.
Yes, thank you very much. The two interrelated questions, let me take them in reverse order. About the timing. We hear that quite frequently, actually regularly. I say, well, we can understand what you're doing, but why are you doing it now? Couldn't you wait till after the summit? Or couldn't you wait till after the budget? Or couldn't you wait until after we issued the benchmark bond next week? Now, the answer to all of this is no. We have to disclose our opinions on an up-to-date basis to the marketplace. If our opinions change, then we have to communicate this to the investor community. This is our duty. We're not operating in a political environment where we're trying to collaborate with the Commission or national governments on producing any certain outcomes. This is not our role. The rating agency's role is much more limited, and this is to opine in a forward-looking fashion on credit risk, and sometimes we agree and sometimes we disagree. On the first part of the question, do we take note of political movements or politicians, individual politicians taking ratings as a target for policy? Say we want to maintain the AAA rating. Of course, we notice that. But we need to understand we're not collaborating with the governments in a way and say, well, if you want to keep the AAA rating, what you should be doing is A, B, and C, because that, again, is not our role. We could not possibly be in any shape or form in an advisory capacity to the government and afterwards opine on credit risk, because we would be part of the process. On the other hand, if there is a government raising the rating as a on the political agenda, this should not preclude us from playing our role, which is opining on credit risk in a way that we would say, well, we would think that the rating should be lowered by a notch, for example, but Mr. So-and-so in government has said this would be sort of against the objectives of the government, because this would impede our independence. So the fact that sometimes governments do raise ratings in the official discussion about objectives of the government is something that we note. It's not necessarily something that we welcome or would have any view on, whether it's advisable or not, but it's nothing that should prevent us from doing the job as we understand it, which is to opine on credit risk in an independent fashion. Because if we were to take that into account as a factor of what to decide and how to communicate it, our independence would start to go on a slippery slope, and we want to prevent that at almost any cost.
Okay, so just very quickly to come back at you on that point, how often then do you do a review? For example, would you review the British credit rating immediately following the budget announcement as a matter of course, for example? And in the case of the US, if you knew that they were about to renegotiate a debt ceiling, would you then carry out a review in the aftermath of that? Or do you have a sort of quarterly review that you do regardless, or how does that work? Do you respond to events or don't you?
We do respond to events. We have, as a general rule, there is a minimum standard that is being set, where you have to have at least sort of one credit committee per year. Now, this is pretty minimalistic, and that may be appropriate for some sovereigns where sort of there's not much happening. And in some cases, this is the standard that we apply. In the cases that you refer to, as you can imagine, these are important events that you describe. We would call a committee and deliberate on what the implications are for our view of creditworthiness of the UK or the US. So indeed, we have credit committees much more frequently in most cases. And whenever the rating changes, we will, of course, within the bounds of the regulation, communicate this as quickly as we can. And sometimes, if we don't change the rating, we do not communicate it, because every day the rating is not changed, it is implicitly affirmed. So if a committee concludes that the rating is all right, we don't have to put out necessarily a press release. We affirm the rating. We can choose to do so if we believe there's investor interest in our views at a particular point in time. But the main obligation is to publish as quickly as we can under our regulatory constraints any rating or outlook changes as they are decided by the credit committee.
Mr. Wilson, anything to add to that?
Briefly, if possible, because there are a couple
we
of
monitor ratings continuously, we review them annually. Whether we would assess the need for a rating change will depend very much on the magnitude, the importance of the development.
So is there somebody in Moody's whose job it is to keep an eye on the UK, for example, and to highlight anything on a minute-by-minute basis? Or how
that's the prime responsibility of the lead analyst, but it's the responsibility of the entire sovereign rating team, and it's a responsibility to which the credit policy function will contribute. It's a responsibility to which a wide range of individuals within Moody's will contribute.
And Mr. Riley?
Yes, I mean, we have a regulatory requirement to provide issuers with 12 hours notice of any pending rating action, which obviously we adhere to. And there are regulations that obviously govern the disclosure of potentially market-sensitive information, which also applies to ratings. Where we're able to meet those requirements, and an issuer, a sovereign, has asked us to issue at the end of the relevant business day, and we're able to accommodate that request, then we have done so. But where we've had requests to delay for a longer period because of forthcoming political auctions or whatever, then that's something which we haven't agreed to, because we don't think that would be consistent with us providing the market participants and potential users of our ratings with an up-to-date view.
Mr. Kraemer, if I can take you back to the discussion we had at the beginning of the session, I just want to clarify one point of fact, which is still somewhat unclear to me. Did you have a rating committee meeting immediately before the US downgrade, and then to take that decision, and then a second one in order to take account of the American government's response prior to publication? Is that what you said?
Let me try to jog my memory. We did have a series of committees on the US. This was a fast developing story. And it wasn't on a daily basis, but it was very frequently. Since I was not part of the team visiting the Treasury, I would not be 100% certain to slot which came first, but it's my understanding that, if I remember correctly, that following the discussions with the Treasury in Washington, the committee reconvened, and that was the committee that took the final decision on the rating action that was then published.
That was the committee meeting that took the final decision?
That was the committee that took the final decision.
Perhaps you confirm that to us. in writing. I'd be grateful if you would. The one other issue has come up quite a bit in the evidence we've taken, and indeed in the March session. And perhaps I could go to you, Mr. Wilson, for an answer. A great deal of detailed work and research, indeed you were intimating exactly that a moment ago, lies behind each of the ratings for the major countries. That research is used to apply the methodology that you have built up and that applies across countries. Why not publish all the research?
Whenever we take a rating action, we will publish a press release which will contain substantially all of the analysis that has gone into our action.
But there's a heap of research behind all that, and the heap of ratings work, isn't there? And why not publish that? Wouldn't that make the underlying credit opinions as well as the headline rating on sovereigns, making all that available, wouldn't that encourage investors to focus on the analysis rather than simply look at the ratings, a point that you've all been making to us?
And the full range of research is available.
But it's not, is it? You meet behind closed doors on the basis of a heap of detailed research, most of which is not published, but only the key points as you see it are published. Those are subsequently put in a press release. That's correct, isn't it?
We will publish...
Just to be clear, that is correct, isn't it?
By publish, I mean put on our website, we have very detailed analyses, typically for each issuer. So we have, for the UK, last December we issued a quite detailed special comment setting out our views on the rating, setting out our views on all of the factors we take into account in determining the UK's rating. And the intention in that, it tries to be readable but detailed enough to provide an understanding of our analysis. The intention is to achieve precisely that, to be transparent and open in why we've reached the decisions we've reached.
I'm still trying to get an answer. I'll have one more go. Why not publish all the underlying research and the views that have been expressed? After all, at your rating committee meetings, why not open up the whole process, provide more transparency? Even the Monetary Policy Committee of the bank is able to publish very detailed minutes.
I mean, what's most important to us, we have a Moody's rating. That Moody's rating needs to reflect a Moody's view. What's most important to us is that what we publish makes very clear what the rating is and why it's where it is, what the Moody's view is. I think you might almost risk obfuscating the clarity if we published a range of preliminary research which wasn't necessarily consistent with that rating.
I have to say, people will find it very bizarre that publishing more material would lead to obfuscation. But I want to see whether Mr. Riley's got anything he wants to add on.
I mean, much of our sovereign research actually is freely accessible. The special reports that we published, for example, in the United Kingdom, the US, Iceland in the past, I think we would certainly review and be sympathetic to the potential of providing our sovereign research free of charge, though ultimately that's a commercial rather than analytical decision, and I don't have responsibility for
don't
that.
worry about the commercials. Let's just concentrate on the point.
I'm very sympathetic, and we are as an agency, to measures which...
More sympathetic than we just heard from Moody's.
Would enhance the transparency, which would include providing a greater range of research.
Okay, what about publishing the minutes of the Sovereign Rating Committee meetings?
Currently, we would view our current press releases essentially as a summary of the key judgments that have been reached within the rating committee. They should broadly reflect the key judgments.
But it's a consensus after all the debate's been had, and what I'm suggesting is you set out the debate.
I think that's something which we could look at and consider. I think there are some difficulties with with that, because when we have debates within the rating committee, first of all, we do sometimes have confidential information which we wouldn't be able to disclose into the public domain through minutes or other research.
Provided to you by the sovereign concern.
Provided by the sovereign authorities, that we may disclose sort of feedback we've had in discussions over policy scenarios, which again would be sensitive for a disclosure. And we want to encourage a rigorous dialogue and debate within the committee. So a potential danger, I'm not saying this would be exclusive, but potential danger is that publication of minutes would potentially render that discussion less rigorous and robust than it currently is.
Well, you could do what the Monetary Policy Committee does, and in those exceptional circumstances redact slightly the material. Have you got views on this, Mr. Kraemer?
Yes, I do, Mr. Chairman. I think two-pronged answer. I actually think most of it is there. We publish twice a year our whole data set that goes into the sovereign ratings. If you look at the methodology and combines of the data that is published by us, which are our own forecasts, which we use as a basis for our decisions, and then plug them more or less in the criteria, I think an informed observer should be coming sort of pretty close to within a notch at least, sort of to our same conclusion. So you can make your own assumptions about where you think the indicators would change and what that would mean for the rating going forward. In terms of the minutes, I would echo. I mean, it's actually an excellent question which we are asking ourselves repeatedly and discussing internally. It is currently our view, and has been our view for some time, and especially in times like these, that it might lead to if you have the participants sort of the committee published how they voted, what their views were.
You can anonymise who said.
Sorry?
You can anonymise who said what.
Yeah, you could do that, but I believe there is. I actually don't think it's so absurd with the obfuscation. I think there is such a thing. If you publish sort of, for example, on all the scores that are in our methodologies, or individual sort of how the votes were coming in one way or the other, you would actually detract from the broader line of argument that we're trying to make. And I think you would have the risk that we see in other indicators that the system is being played.
Okay, well, it's something that maybe it's worth thinking about. All those arguments that you've all come forward with in varying degrees, the least of all Fitch, were deployed with respect to keeping a high degree of confidentiality over discussions prior to interest rate changes, and we've discovered that we can live with a very high level of transparency, and in fact we're much better off as a consequence. Thank you very much for coming to see us this morning. It's been extremely interesting. We've picked up a lot. We may need further exchanges in written form. We've already asked for one, and we're very grateful. Thank you very much.
Thank you.